Ladies and gentlemen, welcome to the English Daily Book Summary YouTube channel. In order to not stop learning, listen to an English book summary every day for free.
Warren Buffett, Charlie Munger, and Alex Morris. Buffett and Munger Unscripted. 3 decades of investment and business insights from the Berkshire Hathaway shareholder meetings. Imagine sitting in a room with 2 of the greatest investors of all time, Warren Buffett and Charlie Munger, listening as they swap insights, crack jokes, and reveal the principles behind their extraordinary success. For over 3 decades, Berkshire Hathaway's annual meetings have offered exactly that, a rare, unscripted look into the minds of these legendary business thinkers. Unlike the usual Wall Street jargon, their advice is refreshingly simple, built on fundamental truths about business, investing, and human nature. Buffett's wit and Munger's wisdom make for an unforgettable masterclass in clear thinking and long-term value creation. Whether they're dissecting market behavior, explaining why most investors overcomplicate things, or warning against common psychological pitfalls, their insights are both practical and timeless. This blink distills their best lessons, captured over 3 decades of candid Q&A sessions, into a clear and actionable framework. You'll discover how to evaluate businesses, allocate capital wisely, and make decisions with conviction, all while keeping a cool head in any market cycle. So, if you're ready to learn from 2 of the sharpest minds in investing, let's dive in. The investment mindset. When Warren Buffett speaks about investing, he often returns to a fundamental truth. Successful investing stems from a deep understanding of businesses, not the stock market. At Berkshire Hathaway's annual meetings, this philosophy comes alive through stories and examples that showcase his approach and how it's created extraordinary wealth over decades. One such example that illustrates this principle is Buffett's 1972 acquisition of See's Candies. When evaluating the business, he didn't rely on complex financial models or market trends. Instead, he asked a simple yet profound question: whether a competitor with $100 million could successfully challenge See's position in California. The answer was no. This basic insight revealed See's strong competitive advantage, a key factor that has contributed to the company generating over $2 billion in profits for Berkshire Hathaway since its purchase. This brings us to the cornerstone of intelligent investing, the circle of competence. You don't need to understand every business or industry, you just need to recognize what you already understand. Buffett illustrates this with a baseball analogy. You're not obligated to swing at every pitch. The key is waiting for opportunities within your circle of knowledge where you can act with conviction. When Buffett first learned about Geico's insurance model in 1951, he spent hours understanding the business because it was simple enough to grasp yet powerful enough to create lasting value. This focus on studying simple, powerful business models naturally leads to what Buffett calls the time horizon. This concept shapes every investment decision in his philosophy. Think of it this way: the market behaves like a voting machine in the short term, swaying with daily opinions and emotions, but acts as a weighing machine in the long run, measuring true business value. A great example of this is Coca-Cola. When Berkshire began buying shares in 1988, many investors balked at the $11 price tag. Buffett looked past the quarterly results and saw the company's enduring advantages and worldwide growth opportunities. By 2023, those shares multiplied more than 20 times, showing how patient ownership of excellent businesses compounds wealth over decades. This leads to perhaps the most important shift in mindset when it comes to investing: thinking like a business owner rather than a stock trader. When you buy shares, you're not buying ticker symbols. You're buying partial ownership in real businesses. This perspective naturally pushes you toward quality companies with predictable economics and away from speculation. It's why Buffett spends his time reading annual reports and understanding business models rather than studying stock charts or market forecasts. These principles offer practical guidance for building lasting wealth. a focus on business basics, staying within known territory, and maintaining long-term vision creates an investment strategy that persists through market cycles. As Buffett says, successful investing requires discipline and adherence to fundamental principles rather than genius-level intelligence. How to approach valuation. Once you understand business fundamentals, valuation becomes the cornerstone of investing. At Berkshire's annual meetings, Buffett and Munger emphasize a refreshingly simple approach. If you need a calculator to determine value, you're overcomplicating things. Simple estimates of future cash flows, combined with patience for the right price, yield better results than complex mathematical models. The concept of intrinsic value, as Buffett explains it, starts with Aesop's ancient wisdom. A bird in the hand is worth two in the bush. But Aesop forgot two important variables: when you'll get the birds and what interest rates are. This framework helped Berkshire evaluate opportunities like the previously mentioned acquisition of See's Candies in 1972, where they could see predictable cash flows even though traditional metrics didn't tell the full story. While See's Candies couldn't reinvest large amounts of capital at high returns, it generated consistent cash that could be deployed elsewhere. It was this seemingly simple business model that became a long-term winner for Berkshire, demonstrating how true value creation, rather than fixating on market multiples or growth projections, leads to superior results. But Buffett and Munger look beyond pure numbers when assessing investments. Many investors obsess over PE ratios or book value, but they focus just as much on competitive advantages and management quality. Experience has taught them that a wonderful business at a fair price creates more value than a fair business at a wonderful price. Tying it all together is the margin of safety principle, which ensures that good analysis leads to good investments. The idea is to invest only when there's a substantial gap between price and value, not just a small discount. Buffett illustrates this with a bridge analogy. Carrying a 9,800-pound load across a 10,000-pound rated bridge requires full confidence in that rating. But with only 4,000 pounds, you can cross without worry. This mindset proved invaluable during downturns like 1973 to 74, when Berkshire acquired stakes in strong companies at steep discounts. While others froze, Berkshire's clear valuation framework allowed for decisive action. This approach's beauty is that it builds on fundamental business understanding while creating clear action guidelines. Valuation is about being approximately right rather than precisely wrong. Detailed spreadsheets weren't necessary when evaluating See's Candies. Understanding that the business had pricing power, customer loyalty, and consistent demand was what mattered. That kind of clarity has guided Berkshire's success across decades and market cycles. So, once you've identified undervalued opportunities, how do you decide where to allocate capital? The key lies in having a disciplined framework for assessing value, which naturally leads to systematic decision-making. As Munger bluntly puts it, it's not supposed to be easy. Anyone who finds it easy is stupid. The challenge is having the discipline to stick to your valuation principles even when the market disagrees. Get the what right, and the how much becomes clear. All things capital deployment. A solid valuation method opens doors, but putting money to work when those doors open brings its own set of challenges. This brings us to capital deployment, the art of actually investing money wisely. Throughout Berkshire's history, Buffett and Munger built a three-part approach to capital deployment: understanding opportunity costs, setting clear investment criteria, and preserving capital above all. This systematic process transformed Berkshire from a struggling textile manufacturer into one of the world's largest companies. Start with opportunity cost, the foundation of every capital decision. When Berkshire looks at any investment, they don't just ask if it's good in isolation. They ask, is this better than every other possible use of our capital? This disciplined thinking led them to bold moves during the 2008 financial crisis, putting billions into Goldman Sachs and General Electric when they needed capital. These investments stood out not just for their attractive terms, but because they beat all other options available then. Next, setting clear investment criteria is crucial, especially when it comes to stock buybacks, an area where many companies lose their way. Most firms repurchase shares without much regard for price, but Berkshire follows a disciplined approach. They only buy when the stock is trading below its intrinsic value. In 2012, Buffett drew a clear line. Berkshire would buy stock when it traded below 120% of book value, a price where they knew they created value for remaining shareholders. This straightforward rule makes sure each dollar spent on buybacks creates more than $1 of value, a basic idea that many companies miss. Finally, capital preservation rules shine through in Berkshire's acquisition strategy. Unlike buyers chasing growth or cost savings, Berkshire focuses on buying great businesses they can hold forever, protecting their investment through quality rather than financial engineering. Think back to their See's Candies purchase in 1972. They didn't storm in with big changes or cost-cutting plans. They kept the management team and let them run things. This light-touch style makes Berkshire the top choice for family businesses looking to sell, creating chances that other corporate buyers never see. Smart capital preservation proves its value not just in the short term, but over years and decades. A prime example is National Indemnity, the insurance company Berkshire acquired in 1967. During tough insurance markets, rather than chasing revenue by writing money-losing policies, the company cut its business by 80%. This patience allowed them to capitalize aggressively when conditions improved, ultimately leading to stronger long-term returns. The strategy aligns perfectly with Buffett's baseball analogy. You can always wait for the perfect pitch. But even the best capital allocation strategies are only as effective as the people executing them. Rules alone aren't enough. They require skilled, motivated managers who think like owners and have the autonomy to act decisively. Finding and empowering the right leaders is a critical part of Berkshire's success. Let's take a closer look at how they do it. Power to the people. A strong capital allocation framework is only as good as the people executing it. That's why Berkshire's approach to management and culture has been pivotal to its success. Buffett and Munger spent decades refining their vision for selecting, motivating, and retaining great leaders, often in ways that challenge conventional corporate wisdom. Their philosophy cuts through bureaucratic noise and focuses on a simple truth: how people actually behave. For them, good leadership isn't about fancy degrees, it's about character. Buffett looks for 3 key traits in managers: intelligence, drive, and integrity. The catch? Without integrity, the first 2 can become dangerous. Berkshire learned this lesson the hard way during the Salomon Brothers crisis of the 1980s, when a single trader broke treasury rules and the CEO hesitated to act. The fallout reinforced Buffett's belief that integrity is non-negotiable. At Salomon, he made it simple. If you lose money, we'll understand. If you lose reputation, there will be consequences. This focus on long-term trust extends to compensation. Unlike most public companies, Berkshire avoids stock options and convoluted bonus formulas. Instead, each business has its own pay plan tied to what managers can directly control. Take Geico, where bonuses are based on policy growth and the performance of existing business. Straightforward incentives that drive lasting value. In contrast, Munger has described many corporate pay structures as the equivalent of letting rats guard the grain supply. Berkshire's decentralized culture is another key driver of its success. Picture this: a headquarters of just 24 people overseeing a workforce of 400,000. Buffett calls it delegation bordering on abdication. This light-touch approach attracts independent-minded managers who thrive on autonomy. After acquiring Nebraska Furniture Mart, for example, founder Rose Blumkin kept running the business exactly as she always had. No committees, no consultants, just an unwavering focus on customers and value. This light touch shapes how they handle problems too. When issues pop up, Berkshire moves fast but stays measured. After Salomon, Buffett brought in a simple rule: think how your actions would play in tomorrow's paper. This basic idea beats thick rule books every time. With Berkshire's deep pockets backing them, managers can prioritize doing the right thing over chasing short-term fixes. But the real test of any management system is succession planning. Instead of searching for another Buffett, Berkshire built a culture designed to outlast any single leader. Managers come aboard knowing their life's work won't be dismantled by the next corporate restructuring or consulting fad. This promise of permanence creates a virtuous cycle, attracting top talent who want to preserve and grow their businesses for the long haul. At its core, Berkshire's success isn't just about capital allocation. It's about understanding people and organizations. This human-centered approach has created extraordinary value over decades. But to fully grasp why it works so well, we need to look at the unique structure that holds it all together. The insurance engine. While Berkshire's structure creates advantages across all its operations, nowhere does this show up more powerfully than in its insurance businesses. Starting with an $8.6 million purchase of National Indemnity in 1967, Berkshire built the world's leading insurance business, now holding $165 billion in float, money they can invest freely until claims need paying. The real power lies in how Berkshire uses this float differently from other insurers. Their massive capital base lets them treat this investment almost like permanent equity. Picture a bank with a single depositor putting in $124 billion and promising never to withdraw it. Add steady cash from non-insurance businesses, and Berkshire can grab opportunities other insurers can't touch. This creates a special position in big deals. When AIG needed to transfer $10 billion in long-term insurance obligations, only Berkshire could step up. Same story when Lloyd's of London needed market support. As the safest port in any storm, Berkshire's position grows stronger. More trust brings more unique deals. Berkshire's success isn't just about financial muscle, it's built on iron discipline. Take National Indemnity, for example. When the insurance market soured, they made a bold move. Instead of chasing revenue by writing risky policies, they slashed premium volume from $366 million to $55 million. They absorbed higher costs rather than pressure employees into bad underwriting decisions, something nearly unheard of in a typical publicly traded company constrained by quarterly earnings expectations. The addition of Ajit Jain in the mid-1980s accelerated this advantage. Walking into Buffett's office on a Saturday morning with no insurance experience, Jain went on to build what became the world's most innovative and profitable reinsurance operation. His disciplined approach to risk-taking, combined with Berkshire's capital strength, created opportunities that simply didn't exist elsewhere in the market. Even when things go wrong, as they did with Genray's acquisition, Berkshire's structure allows for patient correction rather than quick fixes. After identifying cultural issues in underwriting and reserving, management spent years rebuilding the operation's discipline, transforming it back into the premier reinsurer Buffett had originally sought to acquire. This mix, permanent capital, strict underwriting standards, and brilliant people, created something special. With 4 times more capital per dollar of premiums than normal insurers and the ability to take risks others can't, Berkshire's insurance arm shows exactly what makes their approach so powerful. Building something similar would take decades, and they continue to push boundaries and set new standards in the industry. In this blink to Buffett and Munger Unscripted by Warren Buffett, Charlie Munger, and Alex Morris, you've learned that building lasting wealth stems from a complete system of investing, one that transforms market complexity into methodical decisions through deep business understanding, disciplined valuation, and intelligent capital deployment. For Buffett and Munger, investing isn't a guessing game, it's a systematic process. It begins with an owner's mindset, seeing stocks not as ticker symbols, but as real stakes in real businesses. This perspective supports practical valuation, where being approximately right is far better than being precisely wrong. When combined with disciplined capital allocation and strong management partnerships, it creates a powerful framework for identifying and capitalizing on opportunities. At the core of this approach is the insurance model, providing steady capital that fuels patient investing and drives compounding success. These principles have stood the test of time, proving their worth across decades of market cycles by focusing on what truly matters: the fundamental value creation of exceptional businesses. Okay, that's it for this Blink. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you in the next Blink.